So, Mark Twain, Benjamin Franklin, or Karl Marx? Who was it who said, the only thing certain in life are death and taxes? If you guessed Benjamin Franklin, you guessed correctly. I have my own truism I'd like to add to that, and that is, the only thing more complicated than rocket science is tax law. Good morning, everyone. I'm Mark Vecchio. I'm a partner here in the corporate office of Venable. Very happy to greet you this morning on behalf of my colleagues. We've assembled a first-class star of experts in the tax world, combining folks both from here in New York and Washington, D.C. Very briefly, I would like to introduce the crowd. We have, unfortunately, limited time today to cover a lot of material, and so we're going to try to get through this as efficiently as possible. This is kind of very much a 30,000-foot view of some of the more important aspects of the recent changes to our tax legislation here in the United States. We'll probably go for about 45 minutes and then open it up for questions and answers at the end. So let me introduce, without further ado, the panel this morning. To my left is Sam Olczyk, who's the head of our tax policy group. Sam works in our Washington, D.C. office, has spent an immense amount of time on Capitol Hill working directly with lawmakers over the course of his career. He's been with us for, well, now a decade, and is going to be talking to us a little bit about what happened in Washington. How did we get to where we currently are? To Sam's left is Jean Newlin. Jean is a partner in our tax and wealth planning group, and she focuses most of her work on individuals and estates and families that are affected by tax legislation. We'll hear from Jean. After Jean, Mike Bloom. To Jean's left is a counsel here in New York. Mike is a corporate tax attorney and works very, very intensely on corporate transactions and tax aspects of corporate transactions. And finally, Song Huang to Mike's left, similarly a partner here in our New York office who does tax, both domestic and international tax for corporate clients. So, without further ado, Sam, let me ask you to give us the elevator speech on what the hell happened.
Mark, for that inflated introduction. Good morning, everyone. I will say it is a bit odd that we are talking about landmark tax reform legislation when the legislation repealed a grand total of one deduction, the Section 199 domestic production activity deduction, and a total of 0 credits. Having said that, there is no question that this landmark legislation is going to impact individual and business decisions for years to come. Thankfully, I'm not going to talk about any of that. The subject matter experts here are going to delve into the details of the individual and business changes. I am going to speak a tiny bit about how we got here and spend more of my few minutes discussing what to expect next. So why do I have this slide? The tax cut, this is the timeline. The markup in the Ways and Means Committee started November 6th. That was day one of the markup. From November 6th, when the markup started, to the time that the bill was signed into law, December 22nd, was a grand total of 46 days. Some context. The Tax Reform Act, the first significant markup occurred on October 15th of 1985. The bill was signed into law on October 22nd of 1986. So whereas the tax reform legislation, the 2017 legislation, took 46 days to get to the President's desk, the Tax Reform Act of 1986 took 372 days from start to finish. And the reason that I think this is relevant is because it leads into what is going to happen next. This bill has a number of mistakes and a lot of open issues, and that means there's going to be a lot of guidance. Very quickly, the guidance, the IRS is issuing guidance on matters that require immediate, that have an immediate and urgent decision-making process. So, for example, issues like W-4. Yesterday, the IRS issued some guidance on W-4 withholding. We've seen quite a bit of guidance on the 965, the toll charge, because corporations that have repatriated earnings have to pay tax on the first payment is due April 15th, and they need guidance as to how to calculate the amount on which that is subject to tax. The SEC had to issue immediate guidance, as did FASB, for companies with disclosure issues, and there is much more to come. So what to expect next? As I said, there are a number of mistakes and a number of issues spanning from mere technical, typographical to very significant issues. So, for example, this is the statutory language. As you know, it's referred to as the Tax Cuts and Jobs Act, but the Senate parliamentarian, in the last change that was made to the bill, she struck the short title. So the phrase Tax Cuts and Jobs Act appears nowhere in the legislation. But there are 9 provisions that reference the Tax Cuts and Jobs Act. So there are 9 provisions in the law that are not operative. That I call minor issues. If you want to talk about some of the major issues, I represent companies that have, for example, net operating loss carryforwards. The bill limits the use of NOL carryforwards to 80% of taxable income. The idea was that was supposed to take effect in 2018, and the statute should have said for taxable years beginning after 2017. That's not how it was written. Instead, it is written, the effective date says, for losses arising after 2017. So we already had to give guidance to public companies that had NOLs in 2017 as to how to report this for year-end purposes and for financial statement purposes. That is a significant change. For those of you in here who are involved in real estate, qualified improvement property is supposed to be a 15-year recovery period. They forgot to put that in the statute in 16083. So if you're looking for it, you're not going to find it. So those are just a couple of the issues that what I call the significant problems with the statute. If you're looking for, what issues are going to receive a lot of attention or have a lot of questions that have to be answered, it's the international rules, the transition to a territorial system, the global minimum tax and the BEAT, the Bates Erosion Anti-Avoidance Tax, and what Mike's going to touch upon in depth here in just a second, the 20% deduction for pass-through businesses. One would think that given the magnitude of the bill and the speed with which Congress deliberated, that we would be seeing a technical corrections bill. Unfortunately, the technical corrections process has become quite politicized. It used to be a non-controversial approach. That is no longer the case. For those of you in the healthcare area, you will know that we are still waiting for a technical corrections bill for the Affordable Care Act. So I would not hold my breath in terms of when you're going to see a technical corrections bill. I think I've been in discussions with the Joint Committee on Taxation. They are working on a blue book, but they have reminded me that the 86 Act, which was signed into law in October of 86, the blue book came out in May of 87. So thinking that we might see a blue book anytime soon is also, I think, wishful thinking. Of course, we could see some guidance from the IRS, but they are dealing with issues of resource capacity. They just requested almost $500 million of additional budget authority to implement the tax laws, and it would be helpful if we had an IRS commissioner. So, in addition to that, there are also bigger issues at play here. Funding federal government. A week from this Thursday, the money runs out. Debt ceiling, which could be a very, very difficult negotiations, and we are already seeing the impact of the 2018 elections. So I think the takeaway from all this is do your best and make sure that the decisions are grounded in existing law, and perhaps we will be getting more. We'll be getting more guidance from the IRS sooner rather than later. And with that, I will turn it over to Jean, and she can discuss the estate planning opportunities.
Okay, well, I feel depressed. Completely depressed, I think, that nothing's going to happen, but that's all right. So the estate planning side of this and the estate tax side of this is pretty minimal. So I'm going to talk for like 3 seconds and turn it over. No, I'm only kidding. What happened was essentially a doubling of the estate tax exemption. So what does that mean? Now what we have to tell our clients is that moderate estates are between $10 and $25 million. So I think that would make me feel really bad that I'm pretty poor, because moderate estate, 10 to 25 million. Because at this point now, with portability, which was put into the 2012 Act, and a couple now has $22 million of tax, or of estate tax exemption. So what you'll see is there's a little star next to the 11,180,000. They changed the method at which the estate tax exemption increased. So when you look at the chart, you see that since 2011, the estate tax exemption had increased based on an inflationary adjustment. It is now a chained inflation type something or other. And basically this number is all of the smart people who are in ACTEC and other organizations have come up with this number, but no one has actually issued this number. So yet another thing that we're waiting for as a result of this act is what is the exact number of the exemption starting this year. We don't know, obviously, what it'll go to next year. That will come, going forward. But this is a sunset portion of this act as well. So at the end of 2025, starting January 1st of 2026, all of this goes away and we go back to where we started in 2011 plus increases for exemption or increases for inflation based on the former rules that we were under. So that's the interesting part of the Act, and that's really all the Act does, is it says increase of an exemption both for estate tax and generation skipping transfer tax and gift tax. So now clients can gift a considerable amount more, die with a considerable amount more, and have no estate tax. There's still a full step up on your basis when you pass away, just as there was under the prior law. So basically it's just saying rich people have more to die with, don't have to pay any taxes, at least from an estate and gift tax perspective. One of the pieces in the legislation talks about, well, what happens when this sunsets? Do we have to essentially do what's called a clawback? And if you've made a gift using this extra $5 million that you have, you die in 2026, do you have to then pay tax on that additional amount that you gifted? Because when you die, you don't have that additional exemption, at least under the current way the law is written. Those of you who might have attended Heckerling might have heard this. I did not attend Heckerling last week, but basically it sounds like there will be no clawback. It sounds like Treasury is going to issue regulations to state this. But again, these are all things that we're waiting for to see. So then the question comes, well, what do? Do you wait to make gifts? Do you do other things? Probably a good idea to wait. No rush. You got until 2026. Quote unquote, I'll say, because obviously if we have a change in Congress and a change in the White House, all of this could just disappear in a heartbeat. So we'll just have to again see if things change before the end of 2025. That being said, I really do not want to live 2012 all over again at the end of the year and doing last minute planning for everyone with absolutely no, thank yous or whatever when they reenact the law the next year. So that is not a pleasant thing. The next 3 slides I'm going to go through just very quickly because there's a lot more meat in the rest of it. But I think at this point, there's 3 different sort of ways to plan. One is you have clients who aren't going to have an estate tax. These are the clients who, at least from a federal perspective, even if the law changes. So that planning is going to be fairly similar to what you've done. One of the considerations, of course, is always going to be your state level estate tax. New York has an estate tax. Connecticut has an estate tax. I believe New Jersey just got rid of their estate tax. So you do have to take that into consideration if that estate tax exemption from the state level is lower. For example, I work in D.C., So we practice in D.C., Maryland, and Virginia. In Maryland, there is a bill pending because next year they were going to match the federal exemption. There's a bill pending to limit it to $5 million. So that's going to be another thing to see what the states are going to do if they've tied their exemption to the magic number in the code as opposed to an actual number. So Maryland, of course, is saying, well, we didn't expect, we want money. We don't want, $11 million exemption, so we're going to lower it. New York, same issues. Everyone's got those issues who are tied to those exemptions. So planning is still going to go about thinking about whether there's an estate tax for the state level and what that means for the clients. So you're still going to look at your similar planning. You have the middle level, which is the potential estate tax. Those are the people who could have estate tax in 2026 who may not have estate tax now. Those $10 to $22 million estates, the moderate estates. What should you be doing with those people is a big question mark for everybody. Should you use the exemption? Maybe not, because they might need the money. Do you wait and see what's going to happen? Doing things that may be like grats. I'm not going to get into all of the ins and outs, but there's certain planning that you can do, but you want to take that into consideration as to whether this estate tax goes away. And finally, you have your big estates who are always going to be subject to the estate tax because they are so far in excess, and doing planning to make sure to take advantage of this additional exemption. Again, not likely to be the clawback, but you should take that into consideration because if there is a clawback, who pays the tax if there's that additional tax when they die? And who did you make the gift to? And so you might want to take that into consideration just from a thought perspective of, is someone going to pay tax on a gift that went to somebody else and be really upset about that? Most likely happens in a second marriage kind of situation. The other thing that's of interest, and you might have heard people talk about, is on the last part, this is soak up a parent's unused exemptions. So in that scenario, a lot of times people have children who became very successful, but the parents are not necessarily as successful. Kids may be helping them out, buying them a house, or doing nice things for them, but they aren't necessarily as wealthy. And there's a lot of talk lately about the possibility of actually using the parents' exemption through planning. So one thought of that is basically creating a trust for the parents, giving the parent a general power of appointment over the property in the trust. So hopefully parent dies first is the hope, and then the assets can effectively pass down to the grandchildren level or possibly to other children using up that exemption. So again, we're getting the step up in basis on appreciated assets. We're also passing assets to a different level or a different person who doesn't need the assets because they have so much. So there's a lot of writings on that. There's a lot of thought on that. There's obviously issues with general powers of appointment that potentially could have creditor connections depending on the state you're in. But it's an interesting way to plan, particularly for an older generation that may really, not be able to do much planning on their own, but where you're in this sort of, not unique, but it's not going to be everyone's situation. The other side of it too now is we're really focusing on income tax planning in a big way because there are so many people who are outside of the tax from an estate tax perspective and whether they want a gift or not. You've got the same issue with trusts. Trusts are subject to tax both at the federal and the state level. So trusts are taxed at a very high rate of income. So one of the thoughts is you have a situation where trust has been created, 15 years ago or something like that. It's got highly appreciated assets in it. You've got a client who is maybe elderly, maybe not, but they don't have an estate that's ever going to be taxable. Do you push those assets out to that client, to the beneficiary of the trust, so that they will be in their estate and get the step up in basis when they pass away? Obviously, there's more than tax considerations to that. You obviously are not going to do it where the person is going to go get sued tomorrow or go get divorced tomorrow or spend it all if that's a concern. I mean, then of course you have no tax, so who cares? But, so you do think about those issues. And obviously you think about the inside income tax issues as well of holding on to those assets. Are they going to be taxed at a higher rate? So those are just some quick considerations since we have a short period of time and want to give due time to the rest of the panel here. So we'll go from there and take questions later.
Okay, Michael, why don't we hear about how what's famously referred to as the QBI, right? Qualified Business Income. What that means, it's purported to be able to provide lower rates of income to small businesses. Does it really work that way? And what's it all about?
Sure. So we just heard a lot about estate tax. Now we're going to shift over to business taxes, income taxes, and how tax reform affected businesses generally. The hallmark of tax reform was a reduction of the corporate tax rate, 35% to 21%. But not every business operates as a corporation. Most small businesses in America operate as so-called pass-through entities or flow-through entities. These are, as most people know, LLCs, limited partnerships, S corporations. So there was a new deduction enacted in the code to provide tax relief to these particular small businesses, and that's called the deduction for qualified business income. The deduction, just kind of a general rule of thumb, the deduction equals 20% of an individual's, and it's an individual. So if you're a corporate partner in a business, you don't get the benefit of this deduction. So if you're an individual that owns an interest in an LLC and you have your income allocation, you get your K-1 at the end of the year that says you had X dollars of ordinary income. General rule of thumb, subject to the limitations that we're going to talk about, is that you now get a deduction equal to 20% of that amount. What that effectively does is reduces the tax rate on your flow-through income. Without the deduction, it would be taxed at your normal graduated rates in the case of ordinary income. The new highest graduated rate is 37%. It was reduced in connection with tax reform from 39.6, which everyone knows. Well, now it's 37. With this 20% deduction, the effective tax rate on flow-through income is now 29.6. How do you get that? It's pretty simple. It's the 37% rate reduced by 20%. So if none of the limits apply to you, and we'll get into that, your effective tax rate on your flow-through income is now going to be about 29.6%.
And Mike, just to clarify, we're talking federal taxes only at this point, not state tax. Correct?
That's right. You'll still have to report the income for state tax purposes, and now, as most people know, your SALT deduction is limited to $10,000. So we're not going to get into that, but this discussion here relates only to your qualified business income. And interestingly, so most states piggyback off the definition of adjusted federal taxable income. So if you reduce it at the federal level, you will get some benefit at the state level by virtue of just having less taxable income at the federal level, but it's not going to be that much. Certainly not enough to outweigh the loss of your deduction for state income taxes overall. All right, so just kind of walking through the rules mechanically, what is qualified business income? Well, generally, it's income earned from a trade or business other than the trade or business of being an employee. So your wages, your W-2 income doesn't qualify for the deduction. It's only income earned with respect to an ownership interest in a business. Sole proprietorship, LLC, LP, S Corp, etc., not your W-2 wages. And similarly, if you have an S Corp and you are paid reasonable compensation from your S Corporation, that reasonable compensation, whether it's paid or not, it will be deemed. So the IRS will come and say, well, if you worked for your S Corporation, X dollars of those earnings really relate to your performance of services, and that will be carved out of the income that is eligible for this deduction. So it's only your true business income. So that said, there are two key limitations that apply to computing the deduction. Generally, it's a wage limitation, and then there is a phase-out for certain service businesses. Who's subject to the limitations? Only taxpayers that are above a threshold amount of taxable income are subject to these limitations. So if you're below these two limitations shown on the screen, single filer 157.5 or joint filer 315, you don't have to worry about these limitations. You'll get the full 20% deduction. But if you're above this threshold, the two limitations kick in, and we'll show you how they kick in. Okay. The first limitation is a limitation based on wages, true wages, not guaranteed payments paid by the business. And there's a formula. It's basically the limitation equals the greater of two amounts. The first is simply 50% of your allocable wages from the business. The second alternative is designed to help capital-intensive businesses like real estate that often don't have much W-2 wages at the entity level. And that's 25% of the W-2 wages plus 2.5% of the unadjusted basis of depreciable property used in the business. So keep in mind, this is the cost basis, the original acquisition cost of the asset over the depreciable life of that asset. So real estate, 39 years. There's also a rule that says if you have depreciable assets that are depreciable for less than 10 years, it'll give you the benefit for the full 10-year period. And it's a cliff effect. So after that whatever that depreciable period is, you lose the benefit of this 2.5% altogether. So running through a quick example, let's say there's a business, Tom Brady and his trainer, Alex Guerrero, create TB12 LLC. It's an actual LLC. You've seen commercials for it. And it sells apparel, nutritional supplements, and meals. Brady owns, let's say, 80% of TB12. And it has $1 million of taxable income in 2018. It pays its partner, Alex, a guaranteed payment of $150,000 a year. And it has various employees that have $300,000 of W-2 wages. What's Brady's QBI deduction? Well, first thing, Brady's above the threshold amount, so the limitation applies. If he wasn't, we wouldn't have to do this exercise. Let's say this business in particular is not capital intensive, so it's not going to use the alternative test. So as a result, you run through the formula. It's $300,000 of W-2 wages times Brady's share, 80%, times the 50% rule, so that his deduction is capped at $120,000. So without the limit, it would be simply 20% of his allocable share of income, but because of the wage limit, it's $120,000 with respect to this business. Now, keep in mind, each business is going to be tested separately. You don't group them all together. So you have to do this exercise and analyze the capital and the W-2 wages with respect to each business that your clients or you own an interest in. And then, let's see. So there's a little comment at the bottom here, which is note the tension between your classification of employees. If you're able to classify a service provider as an employee, the payments made are wages. They contribute towards the limit. That's good for you. But if you're the service provider, you'd prefer to be classified, subject to all the other things that go into this analysis, but just from a straight QBI analysis perspective, if I'm an independent contractor, that means I have a trade or business. I'm a sole proprietor rendering my services. And therefore, my income is eligible for the deduction. So you will have a tension between your independent contractors and the employees on how to properly classify them, or employers and employees on how to classify them. Next example, pretty simple application of the same test. Let's say you have a business that buys a building for $6 million. You allocate that $6 million, $3 million to the land, $3 million to the building itself. Okay, the building has $500,000 of rental income. Now the maximum deduction would be 20% of that amount, $100,000. Business pays no wages, so your QBI deduction is limited to 2.5% of the depreciable assets. Land is not depreciable, so you only get credit for the building. Well, that means that your deduction would be capped. You would lose $25,000 of the benefit here. But if you are paying attention to your allocations and thinking about this issue in advance of closing the deal, you'd realize, that if you were to allocate an additional $1 million to the building, your deduction would not be limited. So you would get the full $100,000. So that's the first limit, which is based on wages. There's a second limit, which is a phase out of the benefit of the deduction entirely, and that's if you have a specified service businesses. So the definition of service businesses is keyed off 1202 qualified small business stock, for those who know that, which is basically with some modifications. So put it up there. It means a trade or business that is involved in the performance of services in certain fields: health, law, accounting, performing arts, athletics, brokerage services, or where the principal asset of the trade or business is the reputation or skill of one or more of its owners or employees, or which involves the performance of services that consist of investing, investment management, trading, dealing in securities. Okay, that's a lot of stuff. But generally, what this is intended to do is say, if you're really a service provider and you're providing services through an entity, you don't get the benefit of this deduction. It's really, if you own a true business, you can't, it's not intended for doctors, not intended for lawyers or accountants. But, and again, this is only applies to taxpayers above the threshold amount. So if you're a doctor in a rural area and you're making less than this, yes, you get the benefit of the deduction, notwithstanding that you're in one of the prohibited businesses. But most people, especially in New York, are going to have taxable income above these amounts, and the benefit is going to be phased out entirely. You see the phase-out amount. So for single filers, it's phased out over a $50,000 sort of spectrum, and for joint filers, it's $100,000. So kind of getting to the end of this discussion a little bit, there are a lot of open issues to think about. One thing, let me flip to my slides here, is it only applies to trades or businesses, as I mentioned before. So in real estate in particular, you have an open issue of whether or not your real estate activity is truly a trade or business. If your joint venture simply holds triple net lease property, are you in a trade or business, or is that rental income? Because this benefit doesn't apply to investment income, which includes your passive rents. Or should your activity be characterized as a real estate trade or business? And that's a very common question in I guess historical case law, and it's a facts and circumstances analysis, but it's something you need to be concerned about, because depending on what bucket you fall in will determine your eligibility for this deduction. Another issue is the specified service businesses issue. Most companies, or a lot of companies, don't cleanly fall into one category or another. Are you a service business, or are you a, say, sale of goods, manufacturing, whatever business? And oftentimes the things are mixed together. So our simple Tom Brady example, well, they do a lot of consulting and nutritional stuff for their clients, as well as you can buy apparel, you can do all these other things. There are a lot of companies these days, there's an example coming up, but it's like Peloton. You can do these, it's a new business, you can exercise from home, and you can watch real-time workouts and participate in that. Well, if you were to go to Peloton and have a trainer, that person would be providing services to you. Should that change simply by virtue of the fact that the services are now being provided over the internet? And these are all these open issues to think about. Another thing is in the real estate context. You often have various single-purpose entities that own the real estate, and then one management company that's hired, that's paid a fee to manage all of the different properties. Well, so that means there are no, do the W-2 wages paid by the management company and its employees, should those count towards the different income that's earned by the owners of the business from its different LLCs? If you're not allowed to group it, you lose the benefit of all those wages. If you are allowed to group the whole enterprise together, you would get the benefit of those wages from the management company. And there's simply right now no guidance on that. So this is what Sam was talking about when it came to the issue of there's a lot of sort of ambiguities that need to be worked out, and that's another one. So there's our... I quickly want to point something out. Back to that question of, is it a service business? Is it not a specified service business? There are two private letter rulings. One was issued in 2014. One was issued in 2017 that talk about whether or not you have a qualifying trade or business in the 1202 world, but because it piggybacks off the definition, those pieces of guidance should be relevant for our analysis. And there's language in the 2014 PLR, which I found relevant. It's where the service says, the thrust of 1202E3, which is this rule, is that businesses are not qualified trades or businesses if they offer value to customers primarily in the form of services. So that seems to suggest that there's some sort of weighing from the customer's perspective of what are they truly getting. So going back to our Peloton example, what's the primary value that the customer is getting? Is it the session, or is it the bike, the app, the intellectual property, all these other things? And so arguably, there's no clear answer, but I think based on that sort of standard, you would think that the income would be qualified business income. Okay, so now, because we have sort of a new choice of entity framework to think about. We have a pass-through deduction, and then we have reduced corporate tax rates. Should we change our business structures to the new 21% rate? Because still 21% is better than the effective tax rate even with this benefit. But you have to remember that corporations are subject to 2 layers of tax. So when you layer in the second layer of tax, you'll see there's still a pretty sizable rate differential between operating in flow-through form and operating as a C Corp. The C Corp still gets the benefit of being able to deduct state and local income taxes because it's a trade or business expense, whereas if you're operating in flow-through and you report that income, you as an individual don't get to deduct those things. So there is that benefit from a C corporation, but as a general matter, it will not outweigh the benefit of the 10% rate differential. Talking about REITs quickly, REITs are subject to 1 layer of tax, and REITs do very well under this legislation because REIT ordinary income is eligible for the 20% QBI deduction without any limit whatsoever. So if you own an interest in a REIT, your ordinary income is taxed at that favorable 29.6% rate. You don't have to worry about those thresholds whatsoever. Now I'm going to shift to what I think is the second most important provision, which is a new loss limitation rule under the code for excess business losses. Normally, if you're a taxpayer, you're concerned about, well, is my loss passive or is it active? If it's passive, I can only use it against my passive income, and if it's active, I get to use it, great. I don't have to worry about anything else. And so all I'm concerned about is meeting those material participation standards. Well, now it's not that simple. There is a new limitation that applies after the active-passive analysis, which says that your trade or business losses can only be used to offset trade or business income. They can't be used to offset your wages or your investment income. So I have an example of a client where he has qualified small business stock gains, like huge amounts. And prior to this rule, he was benefiting because he had a lot of active losses from his trade or business, and he was able to use those active losses to offset his portfolio income. Well, now, had that same situation occurred under the new rules, that wouldn't be the case, and you'd have a mismatch. That loss would basically only be allowed to the extent of $500,000. And what happens for the excess is that it rolls into the taxpayer's NOL and then becomes a carry forward. So you can use it in future years, but that doesn't help if there's a mismatch in the current year. And again, because of the new NOL rules, NOLs can only be carried forward. You don't have a 2-year carryback anymore. So don't think that, oh, well, if my loss arises next year, I'll just be able to carry it back and all I'm dealing with is a timing difference. It's not a timing difference anymore. It's a mismatch and you might lose it. And again, there's an additional restriction on your ability to use NOLs. It's capped at 80% of your taxable income, so you can't wipe out 100% of your taxable income going forward. At most, if you have an NOL, you'll be able to wipe out 80%. Okay, so That's my piece.
Okay, Sung, I think we're going to really wrap it up here, starting with the very famous issue of carried interests. We heard a lot about that during the campaign. And this most recent legislation has done a fair amount to address the question of how carried interests are going to be taxed. So why don't you tell us what the answer is?
Thank you. Carried interest rule is very similar to the securities law area, right? A securities law rule that looks at whether you are investing in a security or where you are becoming a joint venture partner in a partnership. So a lot of you guys will be familiar with that distinction, right? Where if you are acquiring an investment or instrument rather, right? Where somebody else is managing your money and you remain a passive investor, that chances are that is a security for securities law purposes. Whereas if you are acquiring an instrument where you get to have a meaningful right to participate in the management of the business, chances are that you are a joint venture partner for securities law purposes, meaning that you are not qualified for the protection of the applicable securities laws. Now, the standard that we see for the new carried interest tax rule is very similar. The question is, right, are you receiving, as the manager, money manager, are you receiving an interest in a partnership, right, in exchange for providing services to others, where the other people primarily remain passive and you are sort of the active manager of that money pool? And if that is the case, unless you hold the asset for at least 3 years, the gain from the investment or trading will not qualify as a long-term capital gain. So that really goes after non-corporate taxpayers who hold promotes and profit interest in a fund structure. So it's pretty well tailored to target the people that they thought were abusive in terms of taking advantage of how we can structure partnership allocations. Now, what does that mean? It means the following, that the carried interest rule does not apply to a true joint venture between the money manager and the investor, the money investor rather, right? So you have to look at your structures and see what kind of management rights do your investors have in your fund or joint venture or partnership, what have you. Now, the second exception from the carried interest rule applies to corporations. And when I looked at the statute says corporations. It does not say C Corp. So we have to think, unless there's another change in law down the road, we have to think that if you are holding a carried interest through an S Corp, then the carried interest rule does not apply, so that you can still get long-term capital gain from assets that you've held for more than a year. So a lot of people have been looking at that issue, and as far as I know, people are thinking about using an S Corp to hold or promote when they set up new funds. So that is something that you want to think about and see whether that's practical for you, because it's not necessarily practical for everybody. Because a lot of times carried interests are held by entities where you want to bring in your key employees to compensate them for their efforts, right? Or a lot of times you want to use that vehicle as an investment tool for seed investors or your estate planning purposes, where the S Corp will not work, because S Corp is only available to individual domestic shareholders and certain types of trust. And the third thing that I would like to point out to you about the carried interest rule is the fact that if you are going to move your carried interest around after the fund has been formed, that may be taxable to you, even though that may not have been taxable to you before this new law. In other words, if you received a promote, right, at the time of fund formation, you hold it for a couple of years, and you want to transfer it to an employee compensation vehicle, which a lot of times people do, that may trigger gain to you, even though that may otherwise have been a non-recognition transfer before the new tax law. So that is something that I think you want to think about as you are going forward. Excess interest disallowance. Now, this is the new section 163J. Prior to the new law, the section 163J only applied to particular scenarios where either you had to meet a debt equity threshold or the borrower had to be of a particular kind. So that it typically applied to loans from tax exempt and loans from foreign investors, foreign lenders rather, or loans from REITs to their taxable REIT subsidiaries. So they were targeting particular transactions, and at some point, people realized that that's not going to work because so many people are leveraging their transactions to the point where basically that leverage is eliminating all the true income from tax reporting purposes. Now, so what happened is they replaced and put in an entirely new section 163J, which applies to business interest expenses that any person has. That is the key, business interest expense of any person. It's not just limited to any particular set of loans or lenders. It applies to everybody's business interest. And that is based on and it is capped at your business interest income plus 30% of so-called adjusted taxable income, which is your taxable income excluding certain items. And there is a distinction of that certain items prior to 2022, because up until 2022, you are excluding depreciation, amortization, and depletion allowances, meaning that if you are in a business where you use a lot of depreciable property, right, chances are this rule is not going to hurt you as much as it would other people until 2022. And the other thing is that it has some exceptions. One of the key exceptions is that it does not apply to small and medium-sized businesses. What I mean by small and medium-sized businesses, they are the ones that have less than $25 million in gross receipts on a 3-year average basis. So if you have a business with an average of less than $25 million of gross receipts in a rolling 3-year window, that will not apply to you for that particular year. And by the same token, it will not apply to a real estate business, trader business, that makes an election. And the election format and the timing is to be provided by the IRS. So we will see how that works. But this could be an opportunity for you to think about. So if you are in a real property trader business, right, which is much broader than just holding real property for investment, you don't have to be subject to this interest deduction limitation as long as you make the election. But the election is going to be not revocable. So you have to wait and see until the election procedure comes out and see if that works for you. Because once you make the election, you cannot revoke, and that's kind of hard, once you do that and you realize you made a mistake, right? And also, this excess interest deduction is an item that will be carried forward in a corporate transaction. So if you are doing M&A, this is an item that you want to think about, especially if there is going to be a major change in ownership structure. And there's a special rule for interest deduction limitation for pass-throughs. And especially at the partnership level, right, it's bifurcated. So this deduction limitation is determined at the partnership level. Then the disallowed interest, or excess interest rather, is allocated to the partners. And it's not carried forward by the partnership. So that is something to think about, because now once you get the excess interest deduction, right, what do you do with that? You can only offset that deduction against future excess income from the same partnership. So if you don't have that, you could potentially run into a situation where you have a lot of deductions, right? that you cannot use. And the other thing is that if you have these deductions that you are not currently able to use, what does that do to you? It's going to reduce your partnership interest basis. That is a critical factor to think about, especially if you have leveraged partnership. The reason is, if it's going to reduce your tax basis in the partnership interest, that's going to do a couple of things, right? One, if you are in a business where you get a regular distribution of cash, the cash could result in taxable gain to you, even if the partnership does not make report taxable income. For example, if you have in real estate business, right, where you have a lot of depreciations that lower the basis, that's going to be aggravated by the fact that you have all these interest deductions that you cannot use, but will still even reduce the tax basis further, right? So at some point, you will have a zero basis, and at some point, you will start having taxable gain, because you are going to get cash in excess of your basis. Now, that basis reduction is going to be reconciled at the time when you transfer or redeem your partnership interest. But that's going to result in timing difference for you, because you will not be able to deduct, and you may even have to recognize income or gain on regular distributions, and you would have to wait until you actually dispose of your partnership interest to recover that. So that could be a timing issue to think about. The rules are similar to an S corp, but it's a little different in one aspect. The excess interest is not pushed down to the shareholders. Rather, it's carried, I think it's carried at the S corp level. We'll have to see for the further guidance clarifying on this point. But the carryover rules that apply to the partnerships do not apply to an S corp. Similarly, if you are invested in a REIT, a REIT's excess interest is not allocated to you. Now, new ECI partnership rules. Now, prior to November 27, 2017, the code did not have a provision. The statute did not provide for treatment of partnership sale proceeds as effectively connected income for non-U.S. residents. So the IRS back in the 90s issued a revenue ruling interpreting and going out of its way in a way, saying that a portion of gain from the partnership sale, interest of sale, will be taxed as ECI income to the extent that there is assets that the partnership held that would generate ECI if they were sold at the time of the sale of the partnership interest. Now that has been litigated. There are at least 3 cases that I know of that are being litigated. One of the cases, actually the IRS lost the case, and it is being appealed at the D.C. court. So we will have to see how that comes out of the D.C. court. But starting in November 27, 2017, the tax law provides that a rule similar to the FERPTA withholding rule now applies, meaning that if you are a foreign person investing in an LLC or partnership that is doing business in the U.S., right, and you sell your interest in that business to another person, now you have to pay income tax in the U.S. on account of the ECI that the LLC would have produced had it sold all of its assets at the time of the sale. Not only that, the buyer or the transferee of the interest has to withhold 10% of that ECI amount unless that person receives a non-foreign affidavit from you. What that means is that you have to look at, right, an affidavit very similar to what you would get in a FERPTA setting, meaning when you buy real estate, right? Or you would have to withhold 10%, which is lower than the 15% that applies to a FERPTA asset. And if you don't do that, what happens? This is more draconian than the FERPTA rule. The partnership or the LLC is going to start withholding on you, on your regular distributions to make up that 10% that you do not withhold. So that's an immediate penalty for you. Not only that, I'm sure you guys know that a lot of times people fail to receive the affidavit in a FERPA transaction, right? And hope that the IRS is never going to come to you and knock on your door, right? That will not happen. Why? Because the partnership now has the onus. It has the responsibility to withhold, and they will know better than anybody else if they have any ECI generating asset. So please do look at your documents and look at your tax indemnity, right? And your tax provisions and transferee liability provisions, and see that you have enough protection there. Two other aspects of business transactions that I think are pretty affected by the new tax law. One is the form and the consideration for mergers and acquisitions transactions. This is all because of the things that, for example, Mike talked about, and I have briefly covered, right? Where, we have access business interest rule, we have NOL, which is fairly limited at this point, and also the reduced corporate rate, rate and tax rate, and also two things. One, the slight change in tax law may permit you to structure a stock transaction as an asset transaction for tax purposes. Prior to the new tax law, you could not do 338H10 election or 336E election to treat a stock acquisition as an asset acquisition solely for tax purposes and get the 100% expensing of the assets of the target company. Why? Because of the particular language in the statute that said new. So I didn't realize, but it does matter. If it's new, it has to be new, right? But now the word new is not the only one, right? They have added the language to clarify that it doesn't have to be new as long as you're acquiring assets from an unrelated party. So that's going to have an impact on how people structure their transactions. So it'll be very interesting to see if we see more of abstract transactions that are treated as asset transactions for tax purposes. And the other thing is, a lot of transactions lately have seen the consideration, right, being adjusted based on the tax value of the target. If you have a lot of NOLs or if you have a lot of income, right, then you look at the tax value of the target and see and adjust your consideration, including through a tax receivables agreement, right? Now, that's going to be impacted by the fact that corporate rate is much lower, and there's a different ways of allocating the NOLs and excess business interest. So that's going to have another impact on how people look at M&A transactions. The last thing I would like to do is to point out the fact that the tax law now codifies some thoughts out there that treat interest in unincorporated businesses as real estate. So if you own, I'll give you an example. If you have a general partnership, right, meaning that you and I get together and form a joint venture without filing under a particular state statute, right, and we, using that name of the joint venture, go out and buy real property, right, we can do a 1031, potentially. We can do a 1031 using your interest in the joint venture, the general partnership. And the possibility is that we can have a real estate syndication very similar to how people do the syndication using the TICS or Delaware Statutory Trust, right? But with a much different format for the management of the property. So it's very interesting, and I'm very excited to see how it's going to pan out in the 1031 world. And that's the end of my presentation. Thank you.
Okay, fantastic. Well, one thing that this new legislation is not is the Tax Simplification Act. That became pretty obvious just in the last 45 minutes. I'd like at this point to open up the floor to questions. We have about 10 minutes to take questions from those of you in the audience who might like to ask one or more questions of the panel. But before I do, however, I do want to mention one thing. Sam had mentioned an aspect of what this legislation includes, which was not talked about this morning, and that is the international effects of this legislation, and they are significant to say the least. We are planning on having a special session dealing with the international tax aspects of the recent change in legislation, for those of you who may be interested. So I just wanted to sort of foreshadow that. It's a really interesting thing that's happening, and for those of us who practice in the international arena, is very, very relevant. So stay tuned for that. And in the meantime, sir, did you have a question?
Question for Sam. What's your best guess as to which parts of this are all going to be turned back in 2020? Do I have confidence in
Wow. So we're already seeing generic polling showing that Americans by a double-digit lead would like to see a Democratic Congress. So if we see a Democratic Congress in 2018 and we see a President Biden or President Oprah Winfrey or President John Kerry, I would say the corporate tax rate, if you go back to Secretary Clinton, to go back to President Obama, they wanted to reduce the corporate tax rate to 28%. I could see that happening with that revenue being used for more expansive middle-class tax relief. What was just alluded to, the international rules, the adoption of a territorial system, I could see that, or perhaps maybe a strengthening or an increase in the tax rate on the base erosion, the global minimum tax. So it's going to be in the corporate area. And if there's one takeaway from me on today's presentation, on the policy side, it would be don't plan beyond 2020. Because all these, your CapEx projections, your PV analysis of a permanent 21% corporate rate, it is permanent through 2020, and then after that, all bets are off. And that would also probably include the estate and gift tax, the doubling of the exemption. That was not wildly popular among Democratic circles.
Sam, how about increasing the SALT deduction from $10,000 to something else?
Well, that might be a way to get some votes. So that might be. Now that expires. That already expires at the end of 2025. So if we wait long enough, that will happen. But we could see an acceleration of that come 2020 if the political winds change dramatically.
Any other questions from the crowd? Sir.
Arguing about the federal, well, is there any discussion that anyone now about maybe reducing state taxes?
Anyone care to step into that hornet's nest?
All right, let me take a shot at it. Maybe you'll shout me down, but we'll see. So in New York State, that's a great question, and I think a lot of these are focused on two aspects of the tax law. One is the state and local tax deduction, and the other is the carried interest. State and local tax deduction, I think obviously people are furious about that. So New York, California, and a bunch of other states have been looking at different ways of reducing the cost to the taxpayers in their states. In New York State, as some of you may be aware, Governor Cuomo has proposed a budget bill a couple of weeks ago. In New York State, the way you legislate many of the tax provisions into the law is by adding them as part of the budget bill, annual budget bill, which has to be adopted by April 10th of each year for the next fiscal year. So when he did, he had issued two pieces of documents. One is the actual budget bill, and the other is a 17-page statement of intent, right? Then that statement of intent, he said that he's going to look for ways to mitigate and reduce the burden on the New York resident of the new rule that caps the state and local tax at $10,000. That is not, at least as far as I'm concerned, that's not in the actual budget bill. So it's a political rhetoric at this point. It's not a reality. Now, carried interest, that's a little different, but it's still, in my view, a little at a distance, because the actual budget bill has a proposed amendment to the tax law, New York State tax law, that would require a couple of things: to recharacterize promote as ordinary income, and also add a 17% fairness fee. He calls it a fee, but he also identifies it as an additional tax. So it's not necessarily a fee, it's really a tax, because they all reside within the same sentence. So it's an additional fee, which is an additional tax. But this, even if this makes into the actual final budget bill for next fiscal year, it requires the following. It requires that the 4 neighboring states adopt a substantially similar legislation dealing with carried interest. So the chances are it's not going to be relevant or effective, at least for the foreseeable future, because we don't know of any other state that's trying to do the same thing. I know that a lot of people have been talking about the the state and local tax, making a charitable contribution for the payroll in state and local tax. I know that, for example, my former colleague at the IRS has issued an opinion. Senior counsel in the Income Tax and Accounting Division at the IRS has issued an opinion in 2010, looking at a very sort of an interesting structure where he opined that basically it is okay to treat something like a pilot, pilot, you know what a pilot is, right? Payment in lieu of property tax, right? As a charitable contribution for 170 purposes. But that's not the same as the one that, for example, California is considering. So I'm not sure that that will be acceptable to the IRS when and if California or another state passes it into law. Thank you.
Okay, sir. Yes.
Not a tax lawyer, so I'm going to ask some basic questions. Primarily for Michael. The new deduction, 10% of my business. I assume, first of all, that in addition to the business deduction itself, in other words, the deduction you can have is in addition. For example, if you're LLC owner, that's not referring to the deduction within the LLC, right?
That's right. So you compute the taxable income of the business with all of its deductions, expenses, depreciation, whatever, and then you have taxable income, net income to the owners, and then that net income amount is reduced by 20%.
Okay. And so my second question is, what is the current rule with respect to deduction, the so-called 20% deduction? And secondly, does the deduction only apply to active expenses incurred as your active administration, or
no, that's a good question, and I should have mentioned that before. But you don't have to be active in the business to get the benefit of the 20% reduction. So you can be an LP investor in a fund, really do nothing except you wrote a check to the fund, and that flow-through income would still be reduced by 20%. The active-passive distinction doesn't apply here. What was the question before that?
the current rule, if you're an LLC owner, current rule is this rule, the previous rule actually. If you're an LLC owner, you have other business expenses in connection with the business which cannot, you're not able to deduct. And perhaps, it's still applicable to last year's income because we're finding tax returns.
Right. So I'm not sure I completely follow the question, but are you saying if you incur expenses on behalf of the business?
Well, other limitations similar to this, like 20%, currently apply expenses last year, these are the businesses outside, the LLC itself.
If it depends on what the nature of those expenses are outside the LLC itself. Are they trade or business expenses? Again, so like this limitation is calculated on like a individual activity by activity basis. So if the owner is doing something, is itself considered to be involved in the trade or business and incurring expenses, they would have losses. And those losses would be used or would be eligible to offset income from the QBI because, again, the second rule I talked about was now your QBI losses can only offset QBI income in the current year. Otherwise, they get rolled into your NOL. So, yeah, in that case, if you have losses, expenses individually, and they're trade or business losses, you could use those to offset your qualified business income. I don't know if that helps, but yeah.
Any other questions? Yes, sir.
Does the 20% deduction apply to guaranteed payments to owners?
Does not. Does not.
Any other questions? Well, if not, oh, yes, sir. Okay, one final one.
What happened to a law firm, I mean, are we going to characterize the associates as a partnership?
Probably not. I don't think we'd let our associates do that.
And it probably wouldn't help anyway unless they're really
I mean, if they're
underpaid. Right.
Yeah, they're well compensated, so they wouldn't qualify.
Okay, if there are no other questions, I'd like to thank the panel, gentlemen, and Jean, thank you so much.